We're here to talk about the Silicon Valley real estate market. The first portions, we're going to be going over Silicon Valley as a whole. We'll get into those first three slides. Then we're going to be looking at three interesting metrics for Silicon Valley. Then we start breaking down Silicon Valley by the different counties, being Santa Clara, Alameda, and San Mateo counties. Then we get into the micro markets, which is where I think the real value of the data is. Then just to show you that I have real numbers, there's the tables of numbers, how to participate, and then we get into the Greater Bay Area, being the 5 regions covering 13 counties in Northern California. So let's get into the first data slide. Here, what we're looking at is there's basically 6 different metrics down the left-hand side. The concept is the same. This is the current week right here in the middle. You have 13 weeks looking into the future, and you obviously don't have current data for looking into the future, but you have the past track record. The past track record is based on the previous 10 years. The gray line being the median of that data point, the blue line being the side that favors the buyer the most, the 90 percentile or the 10 percentile, depending on the metric. And then the red is the one that favors the seller the most, the reverse of the buyer, which would be either the 90 or the 10 percentile also. Then as far as numbers, here's where we were 13 weeks ago in raw counts, and then the percentage of normal. So a quarter ago, we had 1,582 listings. That was basically 80% of the inventory you'd expect. Because it's less inventory than you'd expect, it'd favor the seller, which is on the red side, which is why the purple line happens to be almost right on top of the red line. Then you can see 9 weeks ago, we sort of bottomed out, which is when it normally bottoms out. That's basically right around the first of the year. And then we've been growing. But what's noteworthy here is we've been growing more rapidly than normal. So you went from limited inventory, red favoring the seller, to normal inventory, the gray line. And now in the last 3 weeks, you've gone from essentially the gray line up, and you're getting closer now to the blue line than you are from the gray line. In terms of numbers, you now have 1,951 listings. So you have an extra 400 listings roughly. But more importantly, you're now 16% above the level of inventory you'd expect for this time of the year. So we actually have a surplus of inventory now for the first time since the pandemic broke out. So this is the first time basically in 5 years where we've had a surplus, and it may even go back longer than that. I'd have to look at the actual data. Moving on and doing the same thing with offers accepted, you can see that we were at 78% of the offers accepted. The actual raw numbers isn't that important this time of the year because the number fluctuates so much. And now you're at 88%. So the number of offers has gone up, but it's only gone up basically, or 89%, it's only gone up 11%. But jump back up here, and here you've gone up 35%. So your inventory's gone up by 35%, but your offers have only gone up by 11%. Clearly, the offers haven't been limited by the number of listings available to purchase, because otherwise the offers would be going up at the same rate as the supply was going up. And here they're only going up at 1/3, but the increase is only 1/3 the increase in the inventory. What's that doing? It's causing the market to slow down. How do I measure the speed of the marketplace? The seller-buyer balance. This is the supply-demand balance in economic terms. You can see that before the beginning part of the year, the end of last year, we were basically right at the speed we were expecting. So even though we had less inventory and less offers than you'd expect, the balance between the two was in balance. Then you get towards the end of the year, and all of a sudden, the market's slower than normal, and you come up now, and look, we're basically at the blue line. So this is sort of the slowest marketplace you'd expect. And it's not the slowness of the marketplace, it's the speed of the marketplace relative to that 10-year median. So the market is still fast because you're only at 38 days, which is a month less, it's basically 5 weeks, way less than a month and a half, just over a month actually. And most of the country considers something like 3 to 7 months to be typical. That's not the Bay Area. The Bay Area's always had a limited inventory. So the speed, the turnover rate of the marketplace is fast. But compared to the Bay Area, we're actually having a slow turnover rate, which is why you're so close to the blue line. Now, this one is going to almost contradict you. This is simply time to sell. And I measure that by the 75th percentile. So I'm ignoring the first 75% of the sellers that sell and only looking at how long is it taking 3 out of 4 sellers to get that offer accepted. I don't want to go much higher than that because then you look at outliers, but I also don't want to go lower than that because the median seller is going to be taking their offer as soon as they're willing to, usually the first week that the property is on the marketplace. There's 2 real interesting things. The shape of the purple line is basically the shape of the gray line, but it shifted back several weeks. I don't know exactly where you want to take it from, but let's go from here. So you're back 1, 2, 3, 4, 5 weeks. So whatever the change in marketing time is, it's happening 5 weeks earlier than it typically does. And you can see the curve down. But right now, you were actually below the red line. So you were actually having a faster paced market than you'd have ever expected for this time of the year. And now you're slowing down and catching up to the fast paced marketplace. You're selling in 42% of the time you'd expect to be selling because you're still way up here on the line. And now in reality, you're only down here. What do I think is causing that? Well, that's one reason you look at so much data. My hypothesis, and I don't see anything that's contradicted it since I first floated this about 3 weeks ago, is there is enough inventory coming onto the market each week that the buyer demand is being satisfied by that new listings from just that past week. So buyers aren't going back 2, 3, 4 weeks looking at the picked over listings to find the house that works for them. They're getting their needs satisfied only by the new stuff. So even though the days on marketplace would seem to be a strong indicator, I think it's actually an overall indicator the market's weak because the buyers are being satisfied without looking at the over stuff. What would be interesting here, and I don't have the data, and I don't think I can reinvent it because the active inventory disappears and I don't look at active listings, but what would be really telling, and I may just do it going forward, is the days on market for the stuff that's on the marketplace. Because I think that number would actually be increasing. Because here, in order to be counted in this data point, you have to get your offer accepted. You have to accept an offer. And so that's happening in that very fast turnover rate. And because buyers aren't going back and looking at stuff that was on the market and picked over, that number is actually lower than you would expect it to be. That is my explanation. I don't see anything that contradicts it yet, but it's the odd data point out, in my opinion, at this point. Sellers' expectations versus market reality. This is looking at their price reductions. What are they doing? And basically, they're right at the normal level of price reductions. It's a very small number. It's only 0.3%. And the reason it's so small is because the vast majority of the sellers do their homework, price the home property. Their home sells the first or second weekend on the marketplace, and they don't even have time to do a price adjustment. The other thing that's on the positive side is overbidding. And, I don't want to side what I think the market's doing one way or the other. The data speaks for the data. You can see that you're having more overbidding than normal. How do I justify this compared to the other data that suggests the market's slowing down? I suggest this on two main things. One, this is a lagging indicator. So it's lags behind the marketplace 5 weeks. And if you look at this data, the market really hasn't changed but 3, 4 weeks ago. So we're not seeing it in the overbidding yet. Number two, that I think is human nature, is real estate is very cyclical. The cycle that we have in Silicon Valley is the market takes off at the first part of the year. So I think these might be buyers that were back in January that were still optimistic, that jumped in and overbid. And, it may turn out that this number now in another 2, 3 weeks from now starts coming down as we start seeing the more inventory. So that's my explanation. The data is not always going to be in sync, which is why I go probably overkill on the amount and the quantity of my data, but that way you can have the best understanding of the marketplace. Here are the 3 key components: inventory, offers, supply inventory, demand, offers, and then days unsold inventory, the turnover rate, the balance between the two. So what's going on? Look at the increase in this purple line. I mean, that is telling. You went from a shortage of inventory, basically 73% of the inventory you'd expect, up here to about 116% of the inventory you'd expect. So you've had a huge run up in inventory. You've had a slight increase in offers, but the increase in offers has been only from 70% to even less than 90%. So you can see the difference here in just eyeballing it on how much inventory has grown and then how rapidly it's grown since the first year. And you contrast that to the number of offers. And I would actually say that initially the offers were almost keeping up with the increased supply. But this real hesitation here, the current week, 1 week ago, 2 weeks ago, the last couple of weeks has been real telling. Now, a good person that's been paying attention might argue, Richard, that's just a holiday impact. And I would argue this is the holiday impact right here. But as soon as the holiday was over, it's going back up again. So, and then the third one is the days on unsold inventory. Look at how it's basically been climbing. And as I've already said, this dip, I think, was because the holiday, every holiday negatively impacts real estate. And what happens is the sellers don't go on the market for the holiday weekend. The sellers don't go on the market that weekend, but the buyers are still out the week before getting their offers accepted. There's a 1 week lag. And that's the lag that we just went through. And so this week we had an influx of new inventory. So we may have an influx of new offers next week, but I don't think we're going to have a chance to catch up. So I think that's a very telling graph. I think it's showing that the growth of the inventory is far greater than the growth of the number of offers accepted. Now we're looking at each of the components in a little bit more detail. This is your inventory. The gray line here is your typical line. The red line is the least inventory you'd expect, and the blue line is the most inventory you'd expect, and the purple is, of course, the current data. You can see that at the first of the year, everything was absolutely normal. Even for the first week or two, everything was normal. But then fairly quickly, you caught up to the normal line. And then what I would throw out there is basically from this data point, whatever the week that is, which is only about 2 or 3 weeks ago, inventory has actually been pulling away. And once inventory pulls away, it builds up. And then when the buyers realize inventory is building up and there's more selection out there, don't feel the pressure to buy. So there's a little bit of a lag time, and I suspect that's the lag time that we're in currently. Here's inventory. So the concept here is you pull out the gray line and say that's normal, and what percentage is the data line compared to normal. And you can see we started off the beginning part of the year with that shortage somewhere around 73%, and now we're up somewhere around 118%. Maybe that's a little high. Maybe it's only 117%. But clearly more inventory than you'd expect for this time of the year. And the growth rate is pretty significant. Yes, you've had other periods of times when it's grown up like that, but it's noteworthy, and it's an extended growth period vertically. It's, the percentage increase, you're going from, call that 10%, 30%, 40%, somewhere around a 40% increase in the active inventory. That's pretty significant. And it's happening all since the first of the year, which makes it even that much more significant. Here's the offers now. So let's pay attention. Same concept. You're right on the blue line. So less offers than you'd expect. Now, right here, partway after the first of the year, you pulled away and you started catching up towards the gray line. But now, if you look at that carefully, I think that purple line and that gray line is pretty matched. We'll see that on the next slide, which is why I plotted both ways. But to me, it looks pretty matched, and it looks like maybe the purple line's pulled away from the gray line a little bit. So let's look at it. The gray line is actually we're approaching the gray line. So here's the little hesitation, but it's still approaching. So it was actually getting a little closer, and that's why you look at it. But you can see that you're down here somewhere around 89, 88, 89% of the offers that you'd expect, and the inventory was way over 100%. So clearly, if that continues, we're going to have a rapidly increasing number of homes that are sitting on the marketplace. Here is the days unsold inventory. So this is the balance. Here it's very telling. You were basically on the blue line, and then you caught up and you were almost right on the gray line. But look at this turn. I mean, it was between the blue line and the gray line, and now it's turned and going horizontal, and it's now back on the blue line. Here you were improving a couple weeks, and then you did that 90-degree turn, and boom, look at that. You're going up, and you're somewhere around 125%. So you're 25% slower than you are typically. Again, I need to clarify this. Silicon Valley is a fast-paced marketplace, so the market's still fast-paced, but it is 25% slower than you would expect based on the previous 10 years. And the 10 years I use are 2015 through 2024. So this year's data doesn't impact my metric. And I use that 10-year moving median. So next year it's going to be 2016 through 2025, but for now it's 15 through 2024. Here's your days unsold inventory. And again, you can see the drop here happened earlier. So if you compare the purple line to the gray line, it's following the normal pattern. It's just that the purple line is accelerated, and I do not have an explanation for it. And it's not just this year. Here's 2025, Here's 2024 in the same part, midway through first quarter. Here's 2022, midway through first quarter. I skipped over 2023, midway through first quarter. Every one of these peaks is midway through first quarter. This year, our peak was basically at the very end of the fourth quarter or the very beginning of the first quarter. And I would actually say it's last quarter. We didn't even get into this year before the data plummeted. I have no explanation other than that's about the time that new inventory started to increase relative to the number of offers. And so more of your buyers were getting their offers accepted on homes that were the first week, a larger percentage, and that caused the days on market to drop. What I would really wish I had in hindsight, and I don't think there's a way for me to re-engineer the data, is I'd like to know what the days on market is of the properties that are on the marketplace versus the offers that got accepted. I don't download the active inventory. Here is the run up, so you can see that it's really heated up on that days on market because of the timing, and now it's reversed and it's actually cooled down. So it may just cool down and get back up to normal, but it's definitely acting out of sync compared to the other data. Here is your 10% largest price reductions. You can see that you are between the gray line and the blue line, so between a normal marketplace and a buyer's marketplace. You can see the abrupt change at the first of the year got all the way up to hot marketplace, but now you've cooled off and you're back to a normal marketplace, and now you're a little bit on the blue side of a typical marketplace. So the sellers that are taking the largest price reductions are now taking slightly larger price reductions than they typically do. Typically, they'd be up here at somewhere around 8%, and now they're somewhere around 9%. So whether you're reducing your ask price by 8 or 9%, it's not a huge difference, but it's telling that the sellers that are taking those largest price reductions are taking larger price reductions than they normally do, which supports my hypothesis that the homes that are selling on the first week, and now sellers have been on the market for 5 weeks, 6 weeks, since the first of the year, and they're having time to reduce their price, and they're taking those larger price reductions. Here you can see, compared to typical, we were taking less than normal price reductions. We did a U-turn, and now we're back up to normal. Now, I will point out this is about the same increase in normal price reductions as we had most of last year. So it's not a huge increase, but we're back to where we were for most of 2024, where we were taking slightly larger than typical price reductions. Here's the average price reductions. This is a number I don't like as much. The reason I don't like it as much is a lot of sellers are taking 0, but I put it in there for completeness so people can see I'm really not trying to hide the data. In fact, I'm trying to be very transparent. But here the data indicates that the average price reductions are essentially normal. Which one's more significant? I actually would have designed everything all over again. I'd probably have looked at the 15th percentile. But that's a pretty weird number, and I don't like to do things that I can't really justify. So that's why I'm sticking with the 90 percentile. Here you can see the average price reductions basically right at normal. You can see they were a little bit greater than normal for most of 2024, so a slightly different picture. Here's the frequency of price reductions. Price reductions are actually less frequent than they are normally. And that would make sense if the buyer's coming on and feeding on the fresh new listings every week. There's not a lot of sellers that make it to the second and third and fourth week to reduce the price. And that's why you're having less price reductions than normal. But again, I'll point out that it looks like this last week's been level. And I wouldn't be surprised, there's no way to know, if we go from where we are now closer and closer to the gray line, closer to normal, and then eventually cross over and become on the blue side. Here's the frequency compared to normal. You can see that there was the most aggressive marketplace. Clearly, about 4 or 5 weeks ago, we are now slowing down and becoming more normal. Here's the magnitude of overbidding. Now, keep in mind, overbidding is one of those metrics that we need sale price, so it's a lagging indicator. But you can see that right now, there's no question that the overbidding is higher than it typically is. It's the vertical separation. You're not up at the red line by any stretch of the imagination, but you're clearly favoring the red line over the blue line. So you have more aggressive overbidding than you typically do, which would be an accelerating marketplace. But again, it's my current belief that these are lagging by 5 weeks, and the market really didn't turn more than 5 weeks ago. It hasn't even been 5 weeks. So I would actually anticipate this staying up for another week or two, or maybe three, and then turn around and come back towards the gray line. Here is the magnitude of overbidding compared to normal, and you can see there were more overbidding. Now, on this case, because I'm doing a percentage to percentage, I found pretty confusing. So basically, this is saying that you're getting 3.5% more overbidding than you typically do. 3% would be right here, 4% up here, and then you're at 3.5%. So if you're normal overbidding, gray line would be normal overbidding. So zero is not zero overbidding, but it's exactly normal overbidding, whatever that level is. Here you're bidding 3.5% over that number. And you had that number in the first data slide where we had overbidding. Over on the right-hand side, you have had the typical and the actual overbidding. And from memory, the numbers were something like 4.6 and 8.3 or something like that. Here's the frequency of overbidding. So how common is overbidding? Overbidding is actually more common than it typically is. And it has been more common for basically all of 2024 and so far all of 2025. So you have the magnitude, which was the first slides that we were going over, and then the frequency. And that's important because you want to know not only how robust the overbidding is, but how common is the overbidding. And that's what I mean by how frequent, how common is it. Here's compared to normal. So you have more overbidding than normal as far as frequency and commonality. Here now is pricing. And we've already gone back up over the expectation line, which is something like this. And yeah, I would argue that the line should have been sort of steeper than more like this and almost horizontal. But clearly prices now on the purple line halfway through first quarter are basically, a little bit higher than they were halfway through first quarter a year ago, but they're also clearly below where they were the peak of last year. So we're not back up to second quarter pricing yet. And second quarter is basically April 1st through June 30th. But remember, that's when the transaction closes. So those transactions are happening basically March, April, and May is when the transactions are happening when you're having this peak price. And you can see it's normally midway through. So that's why I typically say midway through March, midway through April is sort of typically the peak of the cycle. Here's the monthly payments that you're going to be seeing in the different price range. So this is the cheapest, most affordable home in Silicon Valley. Your monthly mortgage payment would be somewhere right around $6,500, maybe $6,700. The typical house payment is going to be somewhere around $12,500. And the most expensive property home, the 90 percentile, is almost at $26,000. Now, what that's doing is using the conforming high balance rate, which is actually about 5/8% higher than the jumbo money. So these payments are artificially high, but it's a longer metric that I was able to get consistently for a longer period of time. So these are not accurate reflections. Also, typically, if you're buying the most expensive 90% home, you're not getting an 80% loan. Much more accurate presentation, projection down here, but it gives you an idea of payments. And the reason I do this is I believe that houses are bought on payments. And you can see that payments were higher last year than they are now, but you can also see that payments have been flat for the second half of 2023 and most of 2024 and into 2025. They're not completely flat, but you can see that was a gradual increase. And then sometime in 2023, they become horizontal. The payments that people are paying are not continuing to increase. Now we're looking at distribution. I like these graphs because they show you the important part of the metric. And it gives you an idea why I don't look at things like the median. This is the 50 percentile. So this is the median. So you can see there's almost no vertical change in your data back here, where you come out here to the 90 percentile and there's a lot of vertical change. So your metric is more significant. I actually currently am using the 75th percentile of the third quadrant for statisticians. I think that, realistically, something up here in the 85 percentile would be better, but, I can justify using the 75th percentile and it gives you a fair amount of fluctuation, and that's what I use. We're starting off a year ago, March 1st of 2024, which is the dotted line. And that brings up the point, I jump forward a week at a time, 7 calendar days. Here I jump forward 8 days on a normal year to get back to March 1st. I did jump forward 8 days. I gathered the data first thing this morning. but I did not update my label, so I apologize for that. The purple line is the current line, just to give you a reference. So you can see that the time on the marketplace, basically starting right here at the 75th percentile, because back over here, it's the same. And then if you come way back over here, you can say that we're actually slower now. We're taking longer to sell than we did a year ago. So it's really only this upper part of the data slope where we're faster than we were last year. The point of these slides is to watch the directions, and you'll see the dotted lines will go down to here and then turn around and go up. So you can assume that the purple line will get slower. At least that's the presumption, that the trend, the annual trend, is more significant than anything else. So let's step forward. You can see that you're going to slowly going down, and there's sort of the bottom, the fastest of the marketplace, and then you start slowing down. And that's what I'd expect. So I'd expect the purple line to come down and then turn around and go up. You can see that you're slowly marching up, and there's some bounce. And then when we get past Halloween, it really slows down as we get into the end of the year. And right about there on January 10th was the slowest of the marketplace. And look how rapidly it accelerates what we just went through. There's the current data. So the purpose of this is you can see, you would anticipate the line going down, getting faster marketplace, turning around and going up. But it's also educational when you look at, if you come back here to the 70 percentile, you don't see any data. Even at the 75th percentile, you don't see anybody less than you. It's only at these places up here, the longest times on the marketplace, where the market's going to have time to accelerate. Same concept with the sellers that are taking the largest 10 percentile. And you have to look at the percentile, I ignore 2.5%. So I start at 2.5% and I go up to 17.5%. So I'm looking at 15% of the marketplace off shifted by 2.5%. Why am I doing that? Well, I didn't want to get involved in someone mistakenly listing a property at 10 million when they were supposed to list it at $1 million, going back and correcting that, and myself not catching it. In the database, that 10 million, even though it's clearly a data error, stays as the original ask price. I try to catch most of them and adjust them back to what the real intent was. And that's sometimes hard to tell. And if I can't tell with high degree of confidence, I don't. But if the property comes on the market at $10 million and 24 hours later it's at $1 million, it stays at $1 million for a week and sells close to $1 million, I realized that $10 million was just a typo. And those do happen quite frequently. So here we're going to step through and look at the largest price reductions. You can see that last year it slowed down, and there's about the peak of the marketplace somewhere right around April the 5th. And then the market slows down. And then right about here, right around June, we get into the sort of where there's not much of a change from week to week until we now get past Halloween. And once we get past Halloween, right about now, it's going to start dropping. And there was the huge drop. We stay there until about the first of the year, and then we raise back up again. So again, I'd expect the amount of price reductions to decrease a little bit and then turn around and start increasing. Same thing with overbidding. Now, this data is lagging behind by 5 weeks because I need the sold price. And again, the date for 2025 should be March 1st, and I will correct that for next week. And there you can see we're launched off. You're slowly going up. And now the peak of the marketplace is not till middle of May, beginning of May. And that's because it lags behind, and then you're going to slow down. And then you're not going to slow down until probably close to middle of December instead of Halloween. So there's really not, right about there. December 27th is what I saw was where the slowdown. And then basically February 7th was when the market started picking up again. Here now you're looking at the 3 counties that make up Silicon Valley. You have San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. So this is simply the level of inventory. You have to compare their historical levels. Alameda and Santa Clara typically have the same amount of inventory, but Alameda County has way more inventory this year than Santa Clara County does. You can't really compare without looking more carefully San Mateo because it's so much smaller. Looking at offers. So Santa Clara actually has, I don't know if you can see, it's slightly higher. It's up here, and Alameda County is down there. You can see Alameda County poking out on the right-hand side of the blue line just ever so slightly. So even though Alameda County has more inventory, it's selling fewer homes than Santa Clara County. That immediately tells you Santa Clara County is going to have a faster case marketplace in Alameda. Now, you can't tell without looking at the numbers for San Mateo County, but the growth of all three counties is still upwards in the positive direction. Here now is that days unsold inventory. So Santa Clara County has the fastest marketing time. And notice Santa Clara County has already turned around and gone up. San Mateo County has turned around and gone up. And Alameda County has sort of been flat. And Alameda County has got the slowest turnover rate. So it's got the most inventory with the slowest turnover rate, which is sort of almost what you typically expect. Although you could have the most inventory and the most sales and have more sales and inventory and actually have a faster rate. Here's your marketing time. You can see it's all going down, but they're all flat or going up. Santa Clara County has gone up from 1 day. I would say that's gone from 11 days to 10 days. San Mateo County has gone from 14 days to 15 days, and Alameda County is bouncing around at 15 days. Here's the magnitude of price reductions. Santa Clara County has the least price reductions. 100% of it would be a 0% price reduction, so that's 1/10 of 1%. San Mateo County is at half of 1%, and Alameda County is about 2/3 of 1%. Here's the frequency of price reductions. Santa Clara County has the least at only 6%. San Mateo County and Alameda County are tied at 9%. So that means only 9 out of 100 sellers are reducing their price, less than 1 out of 10. Here's the magnitude of overbidding. Santa Clara County has the most overbidding. Sort of surprising that Alameda County, even though it was the slowest county, has the second most overbidding at almost 7.75% overbid. That's the total overbid here. And then San Mateo County has 7% overbidding. Frequency of overbidding, same order. Santa Clara first with the most overbidding at somewhere around 74% overbids. Alameda County at 70%, and San Mateo County at somewhere around 66%. Again, it's interesting that Alameda County is outperforming San Mateo, even though it had the most inventory out there. Here's the long-term appreciation. Santa Clara has the most appreciation, floating somewhere around 100% since 2015, the last 9 months. I plotted at 200 because it's twice double the price. Alameda County and San Mateo County are very close together, somewhere down here around 75% appreciation. Here's your median sold price. San Mateo County is on top by about $30,000 above Santa Clara County, and Alameda County is the more affordable county, quite a bit lower. Just call it $1,207,750. Here you can see a little bit more accurate. $1,207,750 was pretty accurate. Santa Clara County is at $2 million, and San Mateo County is less than $250,000, so about $230,000, $235,000. Here's the estimated payments that go through the same formula, so the order's in the same. So San Mateo County has slightly higher payments than Santa Clara, and Alameda County has the more affordable payments. You can see they're all down from their peak payments. Here now is the micro market areas. Notice how blue the graphs are. The only area that's got any shade of pink at all is Saratoga Los Gatos. Everybody else basically has more than 100% of the inventory you'd expect. Offers accepted, the same concept. Everybody's blue in color. Yeah, that means you have less offers than you expect. Most of them around 88%, very blue. Blue is favoring the buyer. Here's the speed of the marketplace. Everybody's blue or white in color except for Foster City, a very small micro market area. So clearly the market is, although the market's fast, it's slower than it normally is. Here's your raw numbers. This is showing you that you're fast, even though you're slower than normal. Marketing time, all very fast. Most of them are around 2 weeks. So you put your house on the market 2 weeks later, 3 out of 4 sellers have sold their property. Ask price adjustments, very little in Santa Clara County, normal in Alameda County and San Mateo counties. Frequency of price reductions, not very common. So red in color. Magnitude of overbidding, still red in color. So we still have overbidding, but again, this is a lagging indicator by that 5 weeks, the length of escrows at this time of the year. Frequency, not fairly common. So you're seeing somewhere around 3/4 of sellers getting more than their asking price. Here's the long-term appreciation. So the more affordable areas are where the highest appreciation area is. The more expensive areas and the ones that were close to workshop centers are having less price appreciation. Here's the sold price, and instead of just following the median number, which is the middle number, I also add in the 10 percentile and the 90 percentile. So you have a sandwich, you have a range in every area. The blue is the more affordable areas. The reds are the more expensive areas. Here's a summary chart. You can start with your micro market area over on the left-hand side, or your monthly payment and or your price range, and come across and see what your micro market conditions are. Clearly, you can see the San Mateo County coast is the coolest, favoring the buyers the most. Here's the actual raw numbers. You can see that the number of new listings in the past 5 weeks, as of this week, is essentially the same as it was last week. Active inventory is growing. Offers are growing. But days unsold inventory is growing, which is a slowing of the marketplace, except in Alameda County, it was actually getting hotter. And you can figure out what metric. I want to point out we lost another week. So now we have 5 weeks in a row back here at the beginning part of the year that have the least amount of offers. I think all these are going to fall, and we're going to have probably 9 or 10 or maybe even longer weeks in a row where we've had the least amount of volume. So 2025 is starting off as the lowest amount of transactions out of the last 25 years. And I personally think that's significant. We have been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Appreciate it if you would subscribe and like the videos for me. The blue YouTube URL up here takes you to the channel where you can watch all the past episodes or any ones that are interesting for you. You can also type in the shorter green root URL. That becomes valuable because if you add in 2025 Saturday morning at 9 a.m., you can join the presentation live. I'm also curious if anyone would be willing to attend the presentation that currently does not, anytime between Saturday at 9 a.m. and Monday night at 8 p.m. if I change the time. If I got more participation, I would change the time. You also can get the handout by typing in the green root URL, the letter H for handout, 2025, the month 03, the date 01, and that's a 67-page handout of the PowerPoint presentation we went over. And you can also get to any specific episode if you're a regular watcher by typing in the green root URL, the month, year, and date code. Let's get on to the Greater Bay Area. These are the 5 regions that we're going to be talking about. Silicon Valley, that we've already talked about at length, the cities, North Bay, Central Valley, and the Central Coast. Same concept. We look at 5 weeks going back in the rearview mirror. My benchmarks are 2015 through 2024, so the current year doesn't impact my benchmark. Here's the inventory of the 5 regions. Silicon Valley is in the purple. Central Valley is in the yellow. North Bay is in the gray. Central Coast is in the blue, and cities is in the orange. You can see that inventory across the board is going up. It's fairly flat in Santa Cruz, Monterey, but the other 4 are clearly increasing fairly rapidly. Offers across the board are going up in all the areas. You can see Silicon Valley has the most number of offers, and if we go back, you can see it's got less inventory, so it's going to have the faster turnover rate, and that's the next market. So here's Silicon Valley, the fastest turnover. The slowest is the Central Coast. They're all relatively fast because you're selling, even the Central Coast, you're selling everything out in 75 days, 2.5 months. So that's a pretty quick market. You got 2 areas right at 2 months, and then you the fastest 2 areas are the cities and Silicon Valley. But notice that Silicon Valley is flat. The cities is actually increased, which is a slowing marketplace. Central Valley is flat, and the Central Coast is increasing. So the speed of the marketplace is already starting to slow down, or at least indications of it starting to slow down, which if you go back to just last year is earlier, although in Silicon Valley, you had this about the same time, you had this little blip. We also just went through a holiday, so that could be what's impacting the data. This is marketing time. Marketing time is coming down in 3 of the regions, being North Bay, Central Valley, and the cities. It's flat in Silicon Valley, and it's increasing in the Central Coast. I did explain one of the reasons that I believe in Silicon Valley the numbers are coming down. It's because the buyers are being satisfied with the new fresh listings and aren't going over to things that have been shop worn by a week or 2. Here's the price reductions. You can see that price reductions are fairly low in magnitude. I sort of hedge in sort of where I think typical is, the gray line, and that's typical for Silicon Valley. I've hedged everything towards Silicon Valley because that's my marketing area, but it's not that much radically different for the Central Coast, although the Central Coast is probably the lowest, and you can see that it rarely gets up to above 1%. The only time it was that low of price reductions was in 2021 and very early in 2022 before the market did its correction. Here that's sort of a mixed bag. There's really no large increasing. I would call it pretty flat. The only area that's increasing is the Central Coast, and the Central Coast is a fairly small region. This is the frequency of price reductions. You can see it's increasing in both Central Coast and the Central Valley. It's flat and probably going to go down in the North Bay, flat going down in the cities, and flat and going down in Silicon Valley. But, when only 8% of your sellers are doing price reductions in Silicon Valley, 12% in the cities, then you get up to the North Bay and the Central Valley, and they're only at 25 and 28% respectively. And even the Central Coast, the area that's having the most price reductions, is only 34%. So 1 in 3 sellers. That means 2 out of 3 sellers are not reducing their price. This is the overbidding. So how aggressive are buyers? They're fairly aggressive in Silicon Valley and the cities, up both at an 8% overbidding typically. If you come down, the others are pretty mild. Central Coast is actually down 2% at the time you go in with the offer, and the Central Valley is down 0.5%. The North Bay is up 0.5%. So really the only place where there's a significant overbidding going on is up here in the cities and in the Silicon Valley. Frequency of overbidding, Silicon Valley has the most overbidding at just about 71%. Cities is next at about 64%. Then you're down to 30 to 40% for the other 3 regions. Here's long-term appreciation. The clear loser is the cities, where the appreciation has only been 40%. You got essentially a two-way tie here for the Central Valley and Silicon Valley at basically 90% appreciation, and then another two-way tie around 56% appreciation for the Central Coast and for the North Bay. Here's the median sold price for the different regions. You can see that the Silicon Valley and the cities are very close together. I believe the numbers are 1636 for Silicon Valley and 1650 for the city, so a differential of $14,000. So fairly close together. I would call that essentially a tide. You can see they've been very similarly priced for pretty much since 2024. Prior to that, Silicon Valley was less expensive than the cities. So cities has not done well in pricing, and that's why it's not done well in appreciation, or vice versa. They're obviously linked together. Central Coast is down here, median sale price right around $1 million. North Bay at $750,000, and Central Valley, the most affordable area, at $550,000. You can see that Central Valley was actually a little bit higher back in 2022. So was every region was higher in 2022. So all 5 regions have come down on median sell price since 2022. Here's the estimated payments. It's assuming a 80% loan at the high balance conforming loan limits to the national average. You would do better by about 0.5% by simply going with a 30-year fixed jumbo money, but the national average is an easier number to track back in time for comparison purposes. But relatively, the payments are the same. The order is the same as the price. So even though it's hard to tell on this graph, the Silicon Valley is going to be slightly less expensive than the cities. The cities would be the most expensive. The most affordable would be the Central Valley. Here are the actual numbers. I added in, not only do you have the current value here, so you can see what the value is in each area, you can see where it compares to a week ago. So inventory in Santa Clara County, for example, is up 36%. For Silicon Valley, it's up 30%, up 48% from 5 weeks earlier. And then you can see each of the 13 counties on here. I don't have the 5 regions on here. I'll see if I can squeeze them on. Let me see. I'll play around with that for next week. But here's the raw numbers. You can look at whatever metrics are most important. The bright highlighted yellow are sort of the leading indicators. Active inventory and active offers by themselves don't tell you what's going on. And then the sale price over here are lagging indicators, because they require the sale price, which induces a 5-week lag for escrows to close. With that, we're back to the summary. So these are the different chapters. The links are in the YouTube description, so you can jump to the chapter you find most interested. Very open to have any feedback from what someone would like to see that I'm not currently doing, or make improvements to what I am doing. Thanks for joining. Have a great week. Take care. Bye for now.